California new SB9 bill. What kind of precedents does it have setting for the rest of the country later on? We're going to be talking about the fact that the government's going to try and screw you over on your IRAs and not allow you to invest in private placements possibly, and then go through a whole bunch of other news. If you guys haven't yet, join our syndication cram school scheduled for October 16th. Go to simplepassivecashflow.com/syndication to join us there. And here we go. All right, so the first thing we're talking about this week is this SB9 law. It's state of California only, but as you guys know, California has the population is increasing and there is a lot of homeless there. Basically, the way they used to have it before is there were a lot of these single family home neighborhoods. And, this it's one of those bills where it's what it's trying to do, it's trying to redistribute wealth and trying to get these traditionally single family homes to be duplexes or multifamily so it can allow for more dense population growth and lower housing costs. What I think it's going to be doing is opening up California. I think in the short term, it'll relieve some of that need for housing. But a lot of these things take a lot of time, and a lot of people freak out when they see stuff like this. They're like, "Oh my God, the the world is ending. The California real estate market is going to crash because now you have all these single family homes now double in amount of supply and flooding the market." It doesn't happen like that, guys. I mean, in a few years from now, you might see a little bit of. Scoop- I don't think you'll see a decrease in prices because I still feel like there's a low enough supply and there's a decent amount of demand. So I don't think you'll see prices go down at all, let alone crash. But I do think that it'll start to help out the situation where people need lower middle class, that middle market, that dying middle market in the lower middle class housing. Or it might even not do anything. Who knows? Right. But I think the one precedent setting thing with this whole SB9 is it's kind of California and Oregon are typically your more proactive states with these types of things, where you might start to see this in other more neutral states where they start to break open a lot of the old money neighborhoods and bring in allow for more dense building in those areas. If you're a rich person in a single family home neighborhood, you probably don't like this, but for the rest of the majority of the population, probably allows and opens up the market a little bit. So that's all that is. Now this hit a lot of people were talking about this last week, and they still are. So if you haven't been paying attention, there's a bill going in Congress right now to change many things, but what this is they're going after a lot of IRA owners, and supposedly the rumor is this may or may not impact solo 401k folks. And so the big changes that are supposedly coming down the pipeline, we don't know yet. And I've been telling people in my inner circle, just don't freak out yet. Don't be like these YouTube guys that watch YouTube all the time. I guess you guys are watching this on YouTube, so keep watching YouTube. It's fine. It's good news, good entertainment. Like what's happening is Congress is saying, well, now you guys can't invest in your self-directed IRAs and private placements and syndications, which is kind of jacked up in my opinion, because it's like, well, how dare you tell us what to invest in? Some people who are kind of the conspiracy theorists are saying, well, it's because the government is getting in cahoots with all these companies like Vanguard, Fidelity, TD Ameritrade to backdoor them and force them into all these garbage retail products where there's high fees. Maybe that's the case, right? I mean, it probably is the case, but I just find that connection kind of loose a little bit. But what they're saying, for those of you guys who are investing in your retirement accounts, Lane told you a long time ago not to do this stuff because, I don't know why you would want to invest in a retirement account into something that's tax advantage already. I mean, use retirement accounts for things that are non-tax advantage, such as um, like crypto, goes up, but you got to pay a boatload of taxes, which is why you put it into your qualified retirement plans, such as this, or things where you don't get the bonus depreciation or even passive losses, like hard money lending, which is ordinary income. What you want to be doing with these IRAs is, those types of crypto or non-tax advantage things again. I wrote a really long article and I made multiple videos on this. If you go to simplepassivecashflow.com/QRP, if you guys want the whole argument, email me, lane@simplepassivecashflow.com. I'll give you the big blurb on why I'm not a huge fan of investing in retirement accounts unless you make over $330,000 adjusted gross income and you already have like maybe more than half a million dollars in your IRA, which if you're both of those two such criteria, you probably aren't it's very small portion of people out there where it actually makes sense to have a solo 401k or a qualified retirement plan or self-directed IRA, even a Roth in that case. But bigger topic. But anyway, going back to the news here, people are like, well, if you're gonna like not allow me to invest in private placements, what am I going to do? And then people are like freaking out. They're like, oh my God, I'm gonna have to liquidate my positions, and keep telling people, well, this hasn't been signed into law yet, but supposedly what they're saying is they're going to give people 2 years to transition out of the IRA and to dispose of those assets. Or you could just do what I said, what I told everybody to do, and just take a distribution, pay the taxes and the penalties. It's not that much anyway. But yeah, this was a big thing for a lot of people. I would say, for the most part, this will probably change a lot. A lot of times that they'll put something out there just for negotiation to get something else in some other bill, and probably asking, well, why is this all happening? Well, you can thank Uncle Peter Thiel, who backdoored a lot of like Class B shares of PayPal and created like a $10 million plus IRA, and he's kind of like screwed the system, and now the system is looking to get back at him. Unfortunately, millions of Americans who use their retirement accounts as a mechanism for sheltering taxes is also being collateral damage in the first place. What I personally think they should do to just fix the Peter Thiels of the world is just put a cap at $10 million on IRAs. Most of us fit under $10 million in our IRAs. So that would solve that problem. But again, why are they not allowing people to invest in private placements? I don't know. Maybe that's the conspiracy theorists out there that think that it's possibly, they're trying to force people into these retail mainstream Wall Street products. If you guys have any questions, comments, type it into the comment box below. I'm sure it'll make people angry. You're probably wondering what to do. Well, email your congressperson, whoever that is. I've never personally done that before, but supposedly that's what a lot of people do. All right, getting through the news. This came out from the Yardi report, July 2021, saying the national multifamily market continued to post remarkable performance, with asking rents marking another record increase, up 8.3% year-over-year through July. Right now, the average rents are $1,500, which, you got really high end, you got really low end. So whatever that number is, take it with a grain of salt. But the important thing is Yardi Matrix July survey, 50 markets had double-digit rent growth. And they're also saying the gateway metros, which are the metros that got beat up a lot, like New York, San Francisco, Los Angeles, because of the pandemic, where people were moving out of those high-price areas, they are looking like they're making a steady comeback now. And we talk a lot about the Sunbelt states, from Arizona to Texas to the Carolinas, that nice smiley face on the continental United States. Partnership acquires 2,000 unit multifamily portfolio amongst the Sunbelt states here. DOP Capital, I actually know those guys. So it's just, look what the big guys are doing. They're buying it in those states where the economy is doing better and the population is going up. Now, this article I found was pretty interesting out of multi-housing news. The missing middle comes into focus. Why is that? What are they predicting in workforce housing, which we call like the lower middle class, right? Your folks who call our jobs making $700 to 1,200 or paying $700 to $1,200 rent. And again, we don't like to invest in the high end because those are the people that get creamed in recessions, and we don't like to invest in the lower end, the class D, F, C properties or worse, because there are just a lot of headaches to deal with. A lot of you guys are landlords, and you guys know what I'm talking about there. Uh, but one thing that they cited that they're going to see over the next 5 years is municipalities and developers working more closely to identify the population needs and increase supply accordingly. Attractive destinations, they might go to Texas, Florida, but also places like Kansas City, Missouri, and Milwaukee are also popular, which, those two markets are outside that Sun Belt, that smiley face of the continental United States, where people typically will invest these days. Demand will remain steady. Affordable housing is not prone to the same cycles as market rate or luxury developments. Hey, that's what just Lane said a little while ago. An economic downturn, however, expected as the country recovers from COVID-19 may actually create greater demand for an affordable workforce housing. And changes in federal policy can lead to adjustments periods. So watch changes to tax credits and recent related programs closely. And what that is, sometimes what the government will do is they'll give some credits to new builds for lower class builders, where they put a restriction on how much they can bump the rents. I've typically stayed away from those types of investments. The lure and lurk is what the acronym is called. I really want to be in the Section 8 type of arena, but on some of our Class A assets, we have these restrictions, but it's only about 20% of the units where we're supposed to put, keep those units at a low rate. The missing middle affects both renters and cities looking to attract and retain new populations. Looking at domestic migration trends, the current state of affordable housing in central U.S. and the outlook for the region in the coming years. And they show a little chart down here of where majority of folks are moving towards lower cost, larger metros, toward mid-sized metros, and towards small metros, or kind of the same. I mean, it's a general upward trend for all those three folks. This from RealPage, rent-to-income ratios remain steady. There was a bit of a divergence right after the recession in 2008 as it came out of a recession. Actually, I don't really call this a divergence. This is just two graphs put right on top of each other, where you see the median income gradually increasing, and you see the median rent divided by the income sort of staying about steady. So I think you could probably say that that is a good thing. Where right now it's about 22%, and it's at the low was maybe 21%. So that's pretty much been trading in a band. And I would argue that the orange line here, the median income, that's just rising up with the pace of inflation. Also from RealPage, I don't know why don't they just make two charts? Because it confuses a lot of people when they do this. They try and make, like, people are always looking at the intersection point of these charts, or at least I am. And what does it mean? But in this case, the median income is shown here, and who is in each of the asset classes. And for a lot of people that come into our group, the first thing is like, what's class A, what's class B, what's class C? This is the great graphic to show, well, the people that typically live in the A class folks, here's their median income average and their percentage of what their household income that they're putting their money into. I saw an article the other day that I thought was pretty Captain Obvious, where, yeah, rich people who make more tend to save more money. Well, duh, right? And that's what this graphic is also showing here, as the D class tenants making $30,000 a year, their median rent to income is a lot higher at 26% compared to the A-class renters at 20% of their income going to housing. Last article here, Jeff Adler on Resilience of Real Estate from the John Burns podcast. Some of the highlights here, he's talking about the strength of the apartment market is hot. Demand is far outstripping supply. Apartment rents have surged beyond pre-COVID levels as demand has already absorbed excess supply. I think a lot of it has to do with just it was already that trend, right? The demand for lower middle class housing is increasing because population increasing, and development during COVID kind of went on a little pause, and that doesn't help. It says there's a lot of capital coming out of the office and retail sectors attracted to the multifamily and industrial sectors. Build for rent's time to shine. So a lot of these big institutions are doing build for rent. I'm calling that they're going to run into a lot of problems. We saw this back in 2010 when a lot of these hedge funds started to go after single family homes, and they just weren't able to operate rental properties scattered amongst a big many miles. And this is why we invest in apartments, because it's all in one place. And institutions aren't the greatest at managing stuff in the first place. They got a lot of money and they kind of are big and clumsy, and they're not the best operators, which is typically why we'll buy a lot of times from these clunky owners when they mess it up. And then there's a wave of people entering their prime home buying years. The millennials are kind of old at this point. They're actually looking to, they've moved out of their parents' basements, hopefully, but they're also looking to start families and buy houses. A little bit look into the future with excess supply absorbed, apartment supply ramping up, but that's not coming right away. That's a few years away. Metropolitan areas are hot residential markets, especially those in the Carolinas, Floridas, and Texas. Investor activity will follow the migration of people. Inflation is seen today to be more permanent than transitory, given stubbornly high housing costs and the migration of people from high-cost areas to low-cost areas. And increased construction efficiency in the modular offsite construction will be great for industry. However, these improvements are capital intensive, and there are many regulatory obstacles, so that the transition will take time. And that is the end of the report, folks. If you guys like this, we'll see you guys next week, Monday. Please submit your questions, put your comments below for next time. If you guys haven't yet, check out the free book, simplepassivecashflow.com/book. And also check out the syndication cram school that we have coming up. And we'll see you.
My name is Lane Kawoka, and I used to be an engineer, but I quit my day job because I started passively investing. I quickly built my portfolio to 11 rental properties. Then, as an accredited investor, I went to private placements and syndications. Check out my website, simplepassivecashflow.com, and podcast, Simple Passive Cash Flow, and learn more about my journey, and let me show you how the wealthy build wealth.